let's look again about global growth. Again, the U.S. is expected to continue to kind of move down. This is really a redundant graph, and China and India are expected to move up, particularly China. Okay? All right. So, let's look at the global capital markets as opposed to global growth. So in 2011, the stock market, the global stock market was worth $47 trillion. Okay, and the global bond market publicly, 45 trillion plus 54 trillion in loans. Okay, and 110 trillion in bank loans. And so the global economy was, the global capital market is worth about 256 trillion back in 2011. It's grown some since. I'm going to have to find an updated graph, which is about almost 3.5 times the global GDP. So the markets are worth a lot more, which they should be, worth a lot more than annual GDP. All right, that's like looking at the relationship between net income and total assets. You would expect net income to be much smaller than total assets. So the markets represent total assets and GDP represents net income. That's kind of how the relationship works. All right, annual growth in the world capital markets, 12%. So a lot faster global growth in the capital markets. And so the global capital markets have grown faster than global GDP. And again, that is due to the opening up of new economies and new markets. And people are really excited about the opportunity to invest. The economies aren't moving quite as fast as the markets are. And let's see where we are. We're supposed to go through slide 7, so we'll see how far we've gone. The U.S. financial markets are losing ground to international markets. Hold on one second, bear with me, let's see where we are. I want to make sure we haven't gone too far. Oh, we have gone too far. Gone too far. I was afraid of that. I'm going to have to put some slide numbers on here. So let's stop this, and you guys take a break, and we'll come back and go on to clip number 2. Shalom. All right, folks, so let's finish up this clip 1. I had to change the numbering of the clips. Got to merge some slides together, which was good. Did a little bit of work on the slides. So let's finish this clip 1. So we've got 3 more slides to go to finish up clip 1. So the annual growth in the world capital markets from 1980 to 2010, 12%. And so global capital markets are growing faster than global GDP, and this is because the opening up of new markets around the world, and investors from around the world are able to invest in those markets, and so the markets are growing faster than the economies are. Okay, and again, the U.S. financial markets are losing ground to the international markets because the international markets are small and new, and they're growing rapidly. That's a healthy thing. Okay. The U.S. equity market was worth about $3.5 trillion at the end of 1990 and about $24 trillion at the end of 2013. So we had some really healthy growth going on in the U.S. Financial markets, U.S. equity markets for the last 20 years. The world equity market was worth $11 trillion at the end of 1990 and $64 trillion at the end of 2013. So we've had a lot of growth happen in the last 25 to 30 years. Okay. The U.S. bond market was worth approximately $7 trillion at the end of 1990 and $30 trillion at the end of 2013. The world bond market was worth $12 trillion in 1990 and $100 trillion at the end of 2013. So growth in stocks and growth in debt. Let's be careful with that growth in debt. A lot of that debt is government debt, and let me just say this, generally speaking, private sector enterprises tend to spend debt much more efficiently and the government does. So let's be careful when the government starts borrowing a bunch of money. All right, the relative position of each country in the world with their economies and with their with their capital markets is a function of the rate of growth of the economy. Okay, obviously some other countries grew faster than the U.S. between 1980 and 2010, and as U.S. investors, we want to take advantage of the higher returns and the unique return patterns so that we can improve our portfolio's trade-off or profile featuring both risk and return. Can we improve our return and lower our risk by building a truly diversified portfolio? And the fast growth outside of the United States is primarily due to the smaller size and to the earlier development of these economies. As economies, like companies, as they get older and larger, the percentage growth rates will slow down. Okay. All right, so that's where we're going to stop this one, and we'll move on to clip number 2. Shalom. Peace out.